Right, friends, welcome back to lecture number 9. We are discussing various items pertaining to banking operations, a snapshot on banking operations. This is 9th lecture, and previous 2 lectures we discussed about Negotiable Instrument Act and its instruments like check, promissory note, bill of exchange, and those things we covered in module number 7 and 8. So, in this module we are going to cover about loans and advances, base rate, DRI loans, National Housing Bank, reverse mortgage loan. These things we are going to discuss in this module, right. Before going into loans and advances, I would like to recapitulate whatever we have discussed with regard to the deposits and loans in the first class. In the very first lecture, we discussed about various deposits. Deposits are liabilities for the banks, and the average interest rate which the bank is required to pay to the depositors is cost of funds, and cost of funds should be as low as possible. And the second point is with regard to the loans and advances, we discussed in the first class the average interest the bank is receiving on loans and advances is yield, right. Yield is the average interest being received by bank, right. So, the difference between yield and cost of funds, please look into this slide. The difference between yield and cost of funds is net interest margin, and for the viable operations of the bank, net interest margin should be at least 3% of net interest margin is expected for viable banking operations, and some of the new generation private sector banks as well as State Bank of India are able to maintain minimum net interest margin of 3%, whereas small public sector banks are suffering badly and their net interest margin is varying from 2.2 to 2.6%. That's why they are under trouble. These are the issues we learned in the very first class. And if you look at the banking system as a whole, please look into this slide. How the money flows in the banking system. How the money flows in the banking system? You go to the bank and deposit money. That means people or companies deposit money in the banking system, they are deposits. Subsequent to the deposits, banks have to keep certain amount aside, that is CRR and SLR. We are going to discuss in detail about CRR and SLR. The first part, deposits, we have covered in detail. The second one is the CRR and SLR. Banks have to keep certain money aside. That we will discuss in the subsequent classes. And suppose, let us assume around 100 crores bank deposits are there. Out of 100 crores, certain percentage will go away for CRR and SLR, and in the balance amount, banks will give loans. Not only that, banks will make some investments also in the capital market. Banks will give loans, that is one aspect. Second aspect is they can make investments also. And when it comes to loans and advances, certain percentage of loans have to go to priority sector. That is another important area. Out of the total loans and advances, certain percentage have to go to priority sector lending, and we are going to discuss in detail in this class about various types of loans and advances, and in the subsequent classes, monetary policy of Reserve Bank of India with reference to CRR, SLR, repo rate and all those things. And at the same time, in the subsequent classes, we will cover about priority sector lending also. So, this broadly is the how money flows in the banking system. So, in this class, we are going to limit ourselves to loans and advances. So, you may ask, what is the difference between loan and advance? Loan is more formal, not only formal. Specific agreement is executed between the bank and the customer. All the term loans, home loans, these personal loans, these are all comes under loans. The second informal word is advance. Informal word is advance. Sometimes in the banking terminology, this advances are referred to as overdraft facility as well as cash credit advances. That means that is revolving credit. Sometimes in the banking system, people call overdraft cash credit. People put it under the perspective of advances, but there is no clear-cut differentiation between loans and advances, and both convey the same meaning. There will be borrower and the lender. The terms of reference may be different, and finally you can think over in this way. Loans are more structured phenomena. Loans are formal, more structured, definite agreement, definite period, and advances is the loose term, more informal. If you are an employee of organization, sometimes before getting the monthly salary, you will be given some advance before that. That is called advance actually. Suppose your monthly salary is 50,000 rupees. Sometimes you may take some advance from the organization, maybe 1 lakh or 20,000 or 30,000 from the organization in advance. So they are loosely termed as advances. So loans and advances, finally please remember, loans is more structured or formal word. Advances is somewhat a loose and informal word, and in the banking parlance, all the term loans are normally classified as loans, whereas sometimes people call this advances under overdraft as well as cash credit. They put it into the category of advances. There is no hard and fast rule as such. Right friends, so let us look at various types of loans and advances. All of you are well aware there are several types of loans: home loans, personal loans, car loans, loans against securities, agriculture loans, corporate loans, mortgage loans. So these are all examples of various types of loans, right? And before going into the details of these loans, let us look at the index which is followed in the banking system for giving loans. Banks follow certain index for giving loans. That is base rate. That is the minimum or floor rate of interest. Base rate is the minimum or floor rate of interest to be decided by the Asset Liability Management Committee of Banks and to be advertised in a transparent way. Base rate is to be decided by the Asset Liability Management Committee of the banks and is to be advertised in a transparent way, and this base rate is the rate below which no loans can be given by the banks. Base rate is the interest rate below which no loans can be given by the banks except the exempted categories. There are three primary categories of exemptions we are going to discuss in detail, and how the base rate came into existence. Let us look at some historical perspective. And please don't confuse base rate with the bank rate. Bank rate is the rate at which RBI lends to banks and other financial institutions for long term. When RBI is lending to banks or financial institutions for long term, that is bank rate, and bank rate will be decided by the Reserve Bank of India as part of its monetary policy. So please keep it aside. And let us come to base rate. Base rate is the rate to be decided by Asset Liability Management Committee of the banks, below which no loan should be given by the banks except some exempted categories. What is the need of this base rate? Let us look at it. In the year 2003, benchmark prime lending rate came into existence. In the year 2003, benchmark prime lending rate came into existence, and as per the system in vogue in those days, benchmark prime lending rate, loans can be given by the banks. I am talking about those days of benchmark prime lending rate. Even after fixing benchmark prime lending rate, in those days, banks can give loans below benchmark prime lending rate also. In those days, banks have given loans below benchmark prime lending rate also. Some customers got loans at very high interest rate. Some customers got loans at very less interest rate. There was no transparency. And sensing the urgency, Reserve Bank of India constituted a committee under Deepak Mohanty, and Deepak Mohanty committee gave the recommendations probably in the year 2009, and based on the recommendations of Deepak Mohanty committee, this base rate came into existence from 1st July 2010. So, from 1st July 2010, base rate is in existence, and as per this, no loan should be given below base rate except some exempted categories. That means, so as to ensure transparency in the banking operations, this base rate came into existence since 1st July 2010 by replacing benchmark prime lending rate. And 3 primary exemptions are there. For this base rate, banks will decide base rate. After deciding the base rate, there are 3 primary exemptions. First is loans granted under DRI, differential rate of interest. We will discuss in detail a while later. Second is loans to own employees of the bank, including retired employees. Banks can give loans below base rate for the bank's own employees, including retired employees. That is one exemption. The third exemption is loans to depositors of the bank against their own deposits. Loans to depositors of the bank against their own deposits. Somebody deposited 1 lakh rupees fixed deposit for 2 years. Someone deposited rupees 1 lakh fixed deposit for 2 years, but he is in need of some urgent money. He requires some 20,000 rupees. He can take a loan from the bank against that fixed deposit. He can take 20,000 rupees loan from bank against that fixed deposit, and there the interest rate can be below base rate. First is DRI, second for own employees, third for the loans against their own deposits. Let us look at DRI. DRI is a differential rate of interest scheme. Out of the 3 points, I am discussing in detail the first point, DRI. Second and third need not require much explanation, it is very clear. And first point of the exemption I am discussing in detail. DRI is differential rate of interest. This was brought in the year 1972 by the Government of India. Initially, it was for public sector banks only. Subsequently, it was extended to all the scheduled commercial banks. The rule here is all the scheduled commercial banks, excluding regional rural banks, have to lend 1% of their previous year's lending. All the scheduled commercial banks have to lend 1% of their previous year's lending to the disadvantaged sections of the society, to the poorest of the poor in the society at 4% interest. That is DRI scheme. To the disadvantaged sections of society at 4% interest, they have to give loans, and the amount to be given is, total amount to be given is 1% of previous year's lending. And there are several restrictions. Interest is 4%. 40% of the loans should go to SCs and STs. Like that, several conditions are given in that, and this is one exemption for granting loans below base rate. Second and third I have already told you. So, these 3 are the primary exemptions, right? In addition to these, there may be other categories where interest rate may be below base rate. Primary exemptions we have discussed. Other cases where the interest rate can go below base rate. Primary example is agriculture. For agriculture loans, the interest rate is at present 7%. For crop loans in agriculture, the interest rate is 7% up to 3 lakhs for farmer, and 2% interest subvention is given by the central government to the bank. farmers will get at 7% and 2% interest subvention will be given by the central government to the bank. So this is the case where the interest rate can go below base rate. Similarly, in case of rupee export credit, to facilitate exports, sometimes export credit is given by the banks. In such cases also government can give interest subvention, and in such cases this can go below base rate. Similarly, for solar energy projects, government is giving a lot of emphasis on solar energy projects. Government intention is to produce 1 lakh megawatt of solar energy by 2022. For solar energy projects, the rate can go below base rate. Similarly, when the loans are granted to the national organizations like NSTFDC, that is National Scheduled Tribes Finance and Development Corporation, like that National Handicapped Finance and Development Corporation, like that, when the loans are granted to such institutions, then also base rate can be breached. That means interests can be below the base rate. So these are the exemptions. Primary exemptions 3, and some cases when the government gives some subsidy, then the interest rate can go below base rate. We have discussed just now, and other than these, banks cannot give below base rates. Banks cannot lend below base rate other than these exemptions, right? If you look at the loans and advances, there are several loans: home loans, personal loans, car loans. You may ask which carry less interest. Normally, home loans carry less interest. They are just close to base rate. Home loan interest rate is less and they are just above base rate. Subsequently, there may be mortgage loan interest rates, vehicle interest rates, that means for hire purchasing of vehicles. Corporate interest may be around 12%, 13%, 14%, it may change. And personal loans will have more interest, and credit card advances will still have more interest. So, if you ask me which carries less interest, they are normally house loans or home loans, what you call, and the highest interest is for credit card advances. Personal loans will also carry more interest. They may be around 15 to 18%, but credit card interest, if you fail to pay within the grace period, interest is very high. So the point to conclude here is the interest rates where collateral security or when the loan is secured. What is meant by secured loan? The loan is secured when some underlying security is there. That means for home loan, home will be the underlying security. For a vehicle loan, vehicle will be the security. For mortgage loan, some building will be the security. Like that, when some security is there, interest rate will be less. Unsecured loans, when there is no security, there the interest rate will be high, just like credit card, just like personal loans. So the fundamental point to note is when there is security, interest rate will be less. When there is no security, interest rate will be high. Right? In addition to this, I would like to tell you a few more points. The issues pertaining to loans and advances, there are several guidelines given by RBI time to time. RBI has got no say as far as base rate is concerned. RBI has got no say. Banks will decide. Asset Liability Management Committee will decide. They are supposed to review it once in a quarter. It should be properly publicized in newspapers. Base rate is to be publicized. The loans may be on fixed or floating rate basis. Fixed rate means when you are taking a loan for 10 years duration, the interest rate will be fixed for the period of 10 years. If you are taking loan for 10 years period, the interest rate will be fixed for 10 years. It will be constant. Floating rate means it depends on the base rate. If the base rate reduces, your interest rate will reduce. If the base rate increases, your interest rate will increase. So, floating rate interest rates will depend on the market circumstances, specifically on the base rate, but fixed rate is straight. no change throughout the period. Right, that is one thing. Second thing is, normally all the loans are to be serviced every month. You may ask, what is servicing of loan? Servicing of loan is basically paying back. So all the loans are to be serviced normally every month. There is one exemption, agriculture loans. If farmer is taking crop loan, he will pay back only once the harvesting is over. And for the term loans of agriculture also, farmer is to service the loan once in a year only. But for all other type loans, corporate loans, home loans, vehicle loans, personal loans, loan is to be repaid every month. That is the important thing. And banks are free to determine service charges for any transaction. They may impose some service charge when the loan is processed. These are various points about loans and advances and base rate. And let us look at the regulator for housing finance companies. You may ask, what is the regulator for housing finance companies? It is the National Housing Bank. It was established based on Rangarajan Committee report. Headquarters is in New Delhi. And it is the fully owned subsidiary of Reserve Bank of India. National Housing Bank is the fully owned subsidiary of Reserve Bank of India, established in the year 1988 as per National Housing Bank Act 1987, fully owned by Reserve Bank of India. And please don't forget the other institutions fully owned by Reserve Bank of India. One is the DICGC, Deposit Insurance Credit Guarantee Corporation. The second institution fully owned by Reserve Bank of India is Bharatiya Reserve Bank Note Mudran Private Limited. Third one is this National Housing Bank, but the headquarters of NHB is New Delhi. Please don't forget. What is the main function of this NHB? NHB main function is for regulating housing finance companies, and for refinancing different primary lenders. You may ask, what is housing finance company? Please look here, HDFC, LIC HFL, DHFL, these are all examples of housing finance companies. NHB is the regulator for the exclusive housing finance companies. And when the bank is giving loans, home loans, then the regulator will be RBI only. Please don't forget, when the loan is given by some exclusive housing finance company, then the regulator will be NHB. But when the bank is giving loan, house loan, then the regulator will be RBI only. Right? NHB comes into picture for the exclusive housing finance companies, and housing finance companies can collect public deposits also, but the maximum period of the public deposit, if collected by the housing finance companies, is 10 years. Please don't forget. And these various housing finance companies have to collect public deposits with the approval of NHB only. Please don't forget. So the other points I have listed here, and two important points I would like to tell you with regard to the National Housing Bank. One is the NHB Residex. NHB Residex is a residential index for tracking the prices of residential properties in various cities. For tracking the prices of residential properties in various cities of India, this NHB Residex was started in the year 2007, and 100 base was taken. Initially it was started 26 cities across the country. So every 3 months NHB releases Residex or residential index, which indicates the property prices across various cities in the country. The other important one is reverse mortgage loan. Reverse mortgage loan is intended for senior citizens of 60 plus age group when the person is old and he has some fixed property and no other source of income. When the person is old, no other source of income, but he has some fixed property, and subsequently he can mortgage that fixed property to the bank and can get amount every month or as per the agreed terms. This is about reverse mortgage scheme. That means it is intended for senior citizens of 60 plus age group, and for the persons who do not have any other source of income except fixed property, then this property can be mortgaged to the bank and the bank will pay the agreed amount every month, and once the person as well as his or her spouse passes away, then this house will be auctioned and the balance amount will be handed over to the legal heirs. I have listed out all the features of reverse mortgage scheme here. Please go through this, and with this, let us conclude today's 9th module. Please do join for 10th module. We are going to discuss about monetary policy of Reserve Bank of India. Right, friends? Have a nice day. Thank you.